Good afternoon, everybody. Who has just arrived this afternoon? Hands up. First arrived? Terrific. Thanks so much for coming along. Just so you know, the good thing about these expos is that they provide opportunities for people who run their businesses to learn something from them. And they're free of charge, which is great. So we thank the TCCI for putting on these events. Also, TasGas have been involved with some sponsorship, and also the sponsorship for these events comes from the businesses that actually have the booths down the bottom. So without the support of those businesses, expos like this, which are free to you people, would not be able to take place. So we thank very much all the businesses who have become involved with the expo. This gentleman over here, though, is it's great to have Alan with us. Alan, great to see you down from Melbourne in Hobart. Thanks very much for coming. Just a bit about Alan. He's been very successful as a businessman. Alan started a company called Matrix. He developed the lending tools, the business lending tools that the big banks use. So when you go into the bank and you go through the processes, the computer systems, etc., and the tools that they use, Alan is the man that actually generated those. He sold that business in 2009, and then he set up a company called Pearl Financial Services, which was really out there to take on the banks. Correct. Is what he actually did, and he's turned over $1 billion in loans as well. So Pearl Financial Services have been extremely successful. It's great to have people like this along here to talk to us, and we can certainly learn a lot from them. Please make him welcome, Alan Miltz.
Thank you. Thanks. Good afternoon, ladies and gentlemen. A very exciting day for me. This is the 20th year I've lived in Australia. Can everyone tell where my accent comes from? South Africa. I was brought over by a company called Esprit, the clothing company Esprit, and I helped set up Esprit in Australia. And I will never forget my first day in Australia. I arrived in Sydney. Esprit was based in Melbourne, and I got onto a Japanese bus tour on my first day by mistake in Sydney. I sat next to a lovely Japanese gentleman, and we toured around the harbour area. We got out, the two of us, we walked around and got completely lost. We stopped the first Aussie in the street, and we said to him, or the Japanese gentleman said very politely, "Excuse me, sir, where do we find Darling Harbour?" The Aussie looked at him and said, "Mate, you managed to find Pearl Harbour. I'm sure you'll find Darling Harbour." And that was my first day in Australia. Now, after leaving Esprit, I did a lot of work advising the textile, clothing and footwear sectors. And what I realized is that every time I met a CEO or their accountant, they spoke one language and the bank spoke another language. And I had a vision about 13 years ago to standardize the way in which people look at numbers. I created a company called Matrix, and I developed a technique which I branded Optimist. 13 years later, my system is used in every bank in Australia. So anyone who applies for a loan from a business perspective is put through my technique. Most of the accounting profession has adopted it, and about 20,000 corporates around the world. I took the company to 22 countries, and I sold it 2 years ago. Today, I've got a new business, Pearl Financial Services, and I challenge banks. So I optimize people's funding relationships with their bank and lower their cost of borrowings. Now, it was very interesting. When I started my company 13 years ago, I had no capital. And it's very difficult to obtain money if you don't have capital, you don't have a track record, and you go to a bank. So I went to a professional investor, and the wealthiest family in Australia, the Smorgon family, backed me. And if ever you want to get private equity, if you don't want to get money from the bank, this is the formula. you need to demonstrate that your company is a mover. So M stands for management, because a professional investor is backing you. So you need to demonstrate that you, management, have an impeccable track record. O stands for the opportunity. Does your opportunity have a competitive advantage? Is there a high barrier to entry? The management and the opportunity will indicate the valuation of your business. If your value is X and the investor is much lower, it's very difficult to do the deal. If ever you're going to get someone's money in, show them how they're going to get their money out. Do you have an exit strategy? Equity is a very expensive form of funding. R stands for return. If you are a start-up business like I was, you need to prove that you're going to make at least 50% return per annum. If you're a going concern, you need to have about 30%. So the investor has got very high hurdles. If you're not a mover, there's no chance you will get money. Now, I'll never forget the first day the Smorgans invested in my business. This is a summary of an email which I got. And they said, we have made billions as a family. These are our rules. 2 heads are better than 1. Everyone has the right to be heard in a non-threatening way. The truth will be told. Our word is our bond. The needs of the customer come first. There will be no surprises. Put the uncomfortable issues on the table. Promote teamwork and leadership, and be proactive corporate citizens. Now, ladies and gentlemen, what I find in business is that people love to give you the good news. What I tell and I'm on a lot of boards today, I tell every company I go into, I want to hear the bad news first, because I want no surprises, and once I know the bad news, 2 heads are better than 1, we can solve the problem. And David Smorgan, if any of you follow football, the AFL, he's the president of the Bulldogs, this is what he said to me. He said, Alan, if you aim for the moon, you might make the sky. Keep trying. Write things down in black and white, the dream. Get the right people into the organization, the backbone people, not the high flyers. Hard work, no substitute for hard work. Persistence, never give up, and always back your own judgment. I'm going to choose a little case study today to prove my point. And I'm going to show you all the biggest danger is what you don't know about your business. Gary Furniture is based in Melbourne. Gary believes he's doing absolutely brilliantly. Gary imports furniture from China and distributes the furniture to all the majors and independents in Australia, and he says business is brilliant. These are Gary's numbers. Over the last 2 years, revenue grew from 35 to 42 million. Gross margin grew from 10.5 to 13, and EBIT, earnings before interest and tax, grew from 3.7 to 4.6 million. Revenue is vanity, profit is sanity, cash flow is king. We business love profit, and I always tell people your profit is an opinion. You can manipulate your profit. Your balance sheet is an opinion. You can change values. The only fact in a company is cash flow. Please have a look at Gary's business, and in the 2011 year, tell me Gary's cash flow. If anyone gets the right answer, there's a free ticket to Soweto. So what is Gary's cash flow in the current year? It's absolutely no tricks. Gary says I'm doing brilliantly. My revenue, my margins, my profit is growing. Now, just to give you a background, this company is in the hospital division of a bank, and the owner believes he's doing brilliantly. Now, because I've got very limited time today, seriously, any answers, any suggestions? Yes.
8.6 million.
Sorry?
8.6 million.
Positive or negative?
Positive.
So the first answer is positive 8.6 million. And my suggestion is don't listen to your colleagues. Negative? Negative 900,000. And ladies and gentlemen, this happens in every company I ever go into. You ask about profit, everyone gives you the same answer, and you mention cash flow, and everyone's interpretation is different. Now, a very quick way to calculate cash flow. If you've got $10,000 in the bank at the beginning of the year, and you've only got $1,000 in the bank at the end of the year, what's your cash flow? If you start off with 10,000 invested in your bank at the beginning, and you've only got 1,000 in the bank at the end, what's your cash flow? Negative 9. Cash flow is your change in your borrowings. I can look at any company. So Gary Furniture, you've got no cash, but your short-term debt grew from 5 to 7.2 million, and Gary's long-term borrowings grew from 9 to 10. Gary's borrowed 3.2 million. A good storyteller would be asking the following question. Cash flow is the result of growth. Companies need money to grow. I've got a major problem when companies borrow money to fund inefficiency, wastage in management. So I would say to Gary, you've got a minus 3.2 million cash. Did you need 3.2 million to finance your change, to finance your growth of $7 million? What time do I need to finish, by the way? 1:45. Okay, so we got a little bit of time. What is the role of finance in an organization? When I walk into any company, you can compare a business to a funnel. Driving any business is their strategy. That is the filter of your business. And does your strategy give you a competitive advantage? Once you understand strategy, I then look at marketing, because companies should be market-driven. I then say, how does operations support marketing? How do we create innovation? How do we structure our people? And if finance is doing its job well, finance is measuring your funnel. Finance is telling strategy, is it working? Finance is telling marketing, where do we make and where do we lose money? Finance is telling operations, what's the cost of delivering your product or service to the customers? Now, 60 to 70% of companies I walk into have got no clue why they're doing badly. And the reason is primarily they got no strategy. And this is the little matrix I always ask companies. I always say to companies, tell me what you do, Gary, that makes you important to your customers and different to your competitors. Do you have any magic in your business? What do you do that makes you important to customers and different to your competitors? Because I'm telling you now, if you cannot answer that question, your company is competing primarily on price. And everyone who's doing badly blames the economy, they blame their marital status, they blame the industry which they're in. And my answer is, if you're doing badly, the reason is your strategy is not working. So how does finance measure strategy? The two measures I'm obsessed with in a company are cash flow and returns. What cash flow is your company producing? And you've invested a lot of money, Gary. Do you have a return? Any business, I can take any company, and in one sentence, I can explain the company to the owners. And the sentence is, funding equals operations. Gary, you've put money into your business. Gary's got 9.5 million of his own money in the company, and Gary's borrowed from the National Australia Bank 17.3 million. Gary, you've got 26.8 million invested in this company, and that investment is reflected by receivables, inventory, fixed assets, land and buildings, less your payables. So you, the owner, Gary, are responsible for the management of the 26.8 million. Ladies and gentlemen, how do we know if Gary's doing a good job? What do we want from Gary? What do we want from Gary? All of you have got your own business or you work in a business. What should your business be generating? And the answer is, the reason we're going into business is to get a return. Some people call it return on capital. Some people call it return on net assets. The theory is called DuPont, taught at every major university around the world. And I'm going to ask you a question to demonstrate why DuPont is such a great measure. Ladies and gentlemen, what is more important in a business? Your profit and loss or your balance sheet? Put up your hands for those who believe profit's more important. There are a few people who love profit. Who believes the balance sheet's more important? There are a whole lot of people who love the balance sheet. The DuPont formula is simple. I believe it's simple. The DuPont formula says to you, Gary, the reason you've gone into business is equally impacted by your profit as it is by the balance sheet. Your profit and loss and balance sheet are equally important. So Gary's invested 26 million into his business, and Gary's generated a 4.6 million operating profit. So Gary, you have physically taken $26 million and you've converted it into 4.6 million. Gary, you're getting a 17% return. And return is such a beautiful measure because it compares your profit to your balance sheet. If you are a good CEO, not only do you need to be a profit expert, but you need to be a balance sheet efficiency expert as well. So in simple terms, this is what I tell every business. If you want to make money, you need to grow your profit faster than you're growing your investment in your balance sheet. So in other words, Gary, if you want to create cash flow, if you want to make returns, you better be fantastic at profit, but you also need to be an expert in the way you manage your collections from your customers, your inventory holding, your utilization of your assets, how quickly or slowly you pay your suppliers. Because if you can grow profit faster than you're growing your investment in the balance sheet, your return is improving. And in every board meeting that I go into, I draw this graph. And what I say to Gary, if you were the board members of Gary, I would say to you, as at today's date, at the 31st of December 2011, I had 26.7 million in my balance sheet. And I converted it into 4.6 million operating profit. As at today's date, I'm making 17% return for all of you. Gary, you've got 5 strategies. If you continue the way you are, Gary, and you grow, you're going to have to grow in direction C. So if you believe that you're doing well and you continue to grow, you're going to grow in direction C. And as you grow your profit, your balance sheet grows. And as your balance sheet grows, you've got to fund that growth. So this is what people don't realize. You need to communicate to your bank exactly what your strategy is and how much funding you need to obtain to finance your growth. Gary, is it possible to grow your profit without growing the balance sheet? Direction B. Gary, is it possible to get rid of non-performing assets, shrink your balance sheet, and grow your profit? A. Gary, please don't tell me you're going to budget for the same profit, but you need more money. Or E, let's budget for lower profit and we need more money. Finance is the story of your business. I'm measuring your strategy. Which direction should companies be moving in? A, B, C, D, or E? Anywhere between, A is optimal, but it's very short term. Anywhere between C and B is fantastic. So if you're growing your profit faster than you're growing the balance sheet, you're doing marvelously. Now I'm going to skip over a few notes and I'm going to get on to the really important part of my talk. Ladies and gentlemen, there are a lot of young people here, there's some sophisticated people. I believe in the next 20 minutes or whatever, I can change your lives financially. So I'm going to teach you some processes. A story of numbers consists of 4 chapters. If you want to become a storyteller in your business, there are 4 chapters to any financial story. Chapter 1 is about profit. And every person in this room, believe me, understands revenue, margins, overheads, profit. That is a quarter of your story. You cannot look at your business, Gary, and tell me your revenue, your margins, your profit is growing. You've done well. You're telling me about a quarter of the book. Once I understand chapter 1, the next thing I look at is chapter 2, working capital. And working capital is measured in days. I want to understand how quickly people pay you, how much inventory you hold in days, or how quickly or slowly you pay your suppliers. Gary, whenever you think of profit, ask yourself, what's happening in days? I'm going to ask you all a question, and I know that none of you will know the answer, but this is the biggest danger that I see in companies. About 60% of businesses I walk into are profitable, but they've got a bad cash flow. And they do not know, why is my profit strong and my cash flow is bad? Whenever chapter 2 is borrowing more money than chapter 1 makes in margin, volume is detrimental to cash. So Gary's business, assume Gary's importing from furniture from China, he's selling it to retail stores, assume Gary is making 30% margin. Gary says, 30%, brilliant, I'm doing well. But my question to Gary is, how much do you need to borrow from your bank to fund chapter 2? If you're borrowing more than 30 cents in chapter 2 per dollar, then chapter 1 is making 30 and chapter 2 is borrowing more than 30. But no companies ever measure that number. So no one's got a clue what happens as I grow my business. So whenever chapter 2 is greater than chapter 1, volume is detrimental to cash. People who have invested in land and buildings, infrastructure, plant and machinery, are we utilizing it correctly? Are we getting enough asset utilization? The result of my story is cash flow. The result of my story is return. DuPont was a beautiful measure because it says chapter 1 compared to chapter 2 and 3 gives me the 17% return. Cash flow is a beautiful measure. The result of chapter 1, 2, and 3 equals cash. We speak Spanish and your bank speaks Portuguese. Every bank around the world is obsessed with cash flow as measured by your capacity to service your debt. So every bank says, Gary, do you have future cash to service your interest and your maturing debt? Whenever a bank puts pressure on you, it means you've got a cash flow problem. Whenever you've got a cash flow problem, it's either chapter 1, 2, or both. So people need to realize cash flow is your change in your borrowings. The bank knows your cash, so should you. When the bank's putting pressure on you, you know you've got a problem with the way you're running your business. Cash flow is the result of growth and changes in management. Management is responsible for chapter 1 and 2. Management's responsible for your revenue, your margins, your overheads, your EBIT, your collection days, your inventory holdings. Every time you change the way you're running your business, there's an impact on cash. Collect quicker, good for cash. Increase prices, good for cash. Build up inventories, bad for cash. So typically what I do, I sit down with an organization and I tell them, tell me what your business should look like. And Gary says to me, my business, the next dollar I sell, I want to make 30% margin, 10% profit. I want to collect in 60 days. I want to hold 90 days of inventory and pay my suppliers in 60 days. So Gary, people who work for you, the marketing guys, the operational guys, do not understand numbers. So we're going to give them colors. So let's look at good, average, and bad. So Gary says if I get greater than 30% margin, it's good. Between 28 to 30, it's average. Less than 28 is bad, etc., etc. So every month, I can look at Gary's business and I can see what colors he gets. Cash flow is the result of growth and changes in management. Every time your colors go from green to yellow to red, you're stealing money out of your business. If your colors, if you improve the way you run your company and you move in that direction, you create cash. You can make more money, more cash than you've made profit if you've got gains in management. Now, I spent 20 years of my life educating the banks, educating business leaders, and I attended all university courses, and I realized everyone made cash flow so complex. I believe I've cracked the code to make it so simple. There are 7 drivers in a business. If you want to fix your cash flow, there are only 7 things you can do in a company. Marketing, can you increase your prices or change your volume? Operations, can you source better? Finance, can we reduce the overheads? Can you collect quicker? Can you change your inventory and pay suppliers differently? If you understand the following, you understand how to fix a business. Sitting on everyone's desk should be the power of one. What do the 1%ers or one-day changes do to cash? So if I'm sitting down with Gary and Gary says, I've lost 3.2 million, my answer to Gary is, what do you want it to be? And Gary says, break even at worst. Well, Gary, I've got no idea about the furniture industry, but this is your power of one. So Gary, source better out of China, and every 1% better margin is 406,000. Put your prices up by 1%, 187,000. Pay people or collect 1 day quicker. Now Gary collects in 75 days. Every day's worth 118,000. So you can start to do your calculations. If Gary says, I want to improve by $1 million or $2 or $3 million, it's as simple as this. How many 1%ers or 1 day changes do you want to make? I spent 2 years going around with the CEO of the NAB. And I went to 30 locations a year. And the customers loved this. On the National Australia Bank website, I've created a little tool and a video called The Power of One. If you key in 6 numbers about your business, it calculates this for you. So it's called The Power of One on the NAB website. Now it's very interesting, 60% of companies I walk into, volume is detrimental to their cash. The more they sell, the worse their cash is. And the answer is simple. Whenever Chapter 2 working capital borrows more money to fund its cycle, then chapter 1 makes in margin volumes detrimental to cash. You've got a fast growth problem, you're growing broke. And most companies I walk into actually get this. I'm now going to put my banker's hat on. We speak Spanish, your bank speaks Portuguese. Every bank around the world says only lend what customers have the capacity and ability to repay. Today's debt is repaid by tomorrow's cash flow. If ever you go to a bank, the bank is your partner. Don't treat the bank as some type of alien who you dislike. You need to tell the bank what are your assumptions in your cash flow. There are 7 drivers in a business cash flow: price, volume, COGS, overheads, receivable, inventory, and payable. Cash flow quality. When the bank is looking at your business, they're saying to themselves, we lent Gary $3.2 million. Is he borrowing money to grow his $7 million revenue? Or is he borrowing money because the power of one is moving in the wrong direction? Fast growth symptoms. Whenever chapter 2 working capital is greater than chapter 1 gross margin, volume is detrimental to cash. When the bank lends you money, the bank looks at changes in chapters 1, 2, 3, and 4. When the bank lends you money, they provide covenants. Covenants are lending criteria to measure your cash flow. If you breach a bank covenant, it means you've got a cash flow problem. If you've got a cash flow problem, it's either your profitability or your working capital cycle. That's wrong. Now, this is what people don't realize. When you walk into a bank, the people who you meet are the marketing people. They are the relationship managers. These are the people who take you out for lunch. You have a great cup of coffee with them. The people who you never meet is the black box called credit. Unfortunately, these are the guys who price your deal. So the way credit works, if you want to have a good hearing from credit, tell them about who you are. Who's your management team? Who's on your board? What's your track record? Tell them about your industry. Gary, you in the furniture industry? What's your positioning? Are you a market leader? Are you growing quicker than the industry? Tell them about how much money you need. Don't go to a bank and say to them, I need $1 million, and in 6 months' time we go back and ask for another $1 million. You need to understand your borrowings today and in the future. Explain to the bank, if you're a seasonal business, what's your business cycle. Once the bank understands this, they say, how do we structure the deal? Can this company service and repay? What type of security do we need? And what type of covenants and reporting do we put against the business? Now, it was interesting, when I went around with the NAB gentleman, his name was Jeff Greer. He's an Irishman. The most wonderful sense of humor I've ever heard. But I said to Jeff the one day, Jeff, you've been a senior exec in a bank. What do you look for when you're trying to get a new customer? And he said, I look for the word parser, P-A-R-S-E-R-S. The first thing we, the bank, look at is the person. Even if they got a great company, if we don't like them as people, we got no chance, we won't do the deal. A is the amount. Make sure you tell the bank the amount that you need. R stands for repayment. You need to demonstrate to the bank, Gary, you've borrowed $17 million. Do you, Gary, have future cash to service your interest and your maturing debt? S stands for security. The bank says, we've got skin in the game, Gary. We want you to put up some security as well. E stands for expediency. If you are in the construction industry and you've got 6 projects with the bank might say project number is 7, is too risky for us, we got too much exposure to you. R stands for remuneration. Banks price for risk. If you do not tell the bank what I'm telling you today, you will pay excessively for the amount of money you're borrowing. In my company, Pearl Finance, we've done 1.4 billion of refinancing over the last few years by putting pressure on banks. There are over 50 financial institutions, and you need to put pressure on the bank by showing them you understand your business. No bank ever phones you up and says, by the way, we're charging you too much. And S stands for services. The more services a bank provides to you, obviously the better the situation you're in. And I'm going to end off today, and I'm going to simulate a day in the life of a business that I would like to be involved in. What do you discuss? This is the board meeting for Gary. The first thing I do, I put up KPIs of all the 4 chapters in the bank. So Gary, chapter 1, you're a genius. Every period, your profit's improving. However, Gary, your profit and your balance sheet are equally important. Even though you're growing your profit, your balance sheet utilization, your efficiency in your balance sheet is declining. You're not generating enough revenue from this investment that you've got. So great profit at the expense of the balance sheet. And the reason your balance sheet's going bad, Gary, is chapter 2 working capital. You're borrowing more and more money to finance chapter 2. Chapter 1 and chapter 2 are equally important. Whenever you borrow more in chapter 2, then chapter 1 makes in margin volumes detrimental to cash. Gary, we borrowed an extra 3.2 million from the bank. And this is the ratio used by the bank. The bank says for every dollar Gary owes them, he's got negative 66 cents to repay them. So Gary, like all of us, love profit. Gary says, I'm doing brilliantly. If you were a storyteller of 4 chapters, you would have the only green you would have is chapter 1. There's a red in working capital, it's growing. Gary's cash flow is bad. Gary cannot repay the bank, but yet this gentleman believes he's doing brilliantly. And my biggest problem is what you don't know about your own business. So Gary, the good news is your margins are growing, your profit's growing, but Gary, when we look at chapter 2, you're collecting slower, your inventory is going through the roof, and because you've got no cash, you're paying the suppliers very slowly. And Gary, your business clock is getting longer and longer. Your cycle's getting slower and slower. And Gary, can you see chapter 2 working capital is greater than chapter 1 margin? Volume is detrimental to cash. The more you grow, the worse your cash flow gets. And I'm going to end off today with a true story. I advise a little mini supermarket just outside of Melbourne. The owner, Mike, has had no competition for 20 years. Mike has been making super profits, charging exorbitant prices, and last year Safeways opened up right next to Mike. And on the first day of opening, Safeways put a big neon sign saying butter, $5 a kilo. And Mike immediately reacted by putting a sign outside his store saying butter, $4 a kilo. The Safeway said butter, $3, and Mike went down extremely hard and said butter, 50 cents a kilo. And I went to Mike and I said, oh, you're an absolute moron. I've been teaching you about cash flow. You're going to go bankrupt if you do this. And Mike looked at me in his very strong Aussie accent and said, mate, don't bloody worry about the moron. I don't sell butter. Ladies and gentlemen, I'm going to start and end the same way. Revenue is vanity. Profit is sanity. Cash flow is king. Thank you very much.
questions, Alan?
Any questions?
Any questions?
Everyone shell-shocked. I think a good idea, did you find the notes useful as a reference guide? I can email my notes to the presenters or to the actual organisers. And again, anyone who wants to contact me, either come meet me now, I'll give you a card, or my details will be on the notes. Yes, no questions.
Alan, you're also around for a little bit longer this afternoon here as well if anyone wants to come and talk to you individually.
No problem.
No problem at all? Terrific. So if anyone's got any questions they want to actually privately talk to Alan about, no problems at all. Any questions anywhere? Alan, thank you very much. That was insightful.
Thank you so
It
much.
really was. True. Please put your hands together for Alan Miltz.